Richie Owens here from markmeldrum.com with a quick video touching on IFRS 18. Not mandatory till 2027, so not something to panic about for your exam, but interesting nonetheless, and we're going to highlight how it could be useful to us by doing a little bit of extended DuPont, just to build on last week's video. And we're going to do it by looking at old friend Walmart. Here is Walmart's income statement. Now, I'm not going to bring up its balance sheet and do all the basic DuPont calculations again. Take a look at last week's video if you want to see that. But just to highlight, this is really what we're going to be working with and using to highlight how much fun and how useful IFRS 18 is going to be. We're going to get down to net income, consolidated net income. I'm going to ignore non-controlling interest. I'm going to ignore that in net income. I'm going to ignore it in equity as well. There are other approaches, but that's what we're going to do for simplicity. This is obviously our return when we're trying to calculate ROE. We'd need to divide that by average equity, which I just happen to have done right here. So you can see our net income from 24, and I've got the comparable. Divide that by average equity, 16,270 over 82,77, and you'll get your ROE of 20.27. Compared to last year, 11,292 over 79,973, only 14.12. That is a hefty increase. So it really does lend itself to a little bit of DuPont. Here's our basic DuPont. Net margin times asset turnover times leverage gives us our ROE. Does it tell us anything about what went on? Why did ROE leap from 14 up to 20? Well, nothing really happening in leverage. Not that much happening in asset turnover. What we can see is a big change in net margin from 1.86 up to 2.51, going from 23 to 24. So I'm interested in why that's happened, which is where the world of extended DuPont comes in. I want to break this net margin down into its components, and I'm going to break it down into three components, which makes it easy to remember. DuPont itself breaks ROE down into three components. When you extend DuPont, you break net margin down into three components. That's it. And then you still multiply by asset turnover and leverage. Now, how do you remember this? And just to kind of go off on a tangent a little bit, people often say, any tricks to remembering it, any cheats, anything like that? Don't try and cheat this exam. If you look out there on the internet at the moment, in the run-up to the exam, there are so many things flying around called quick sheets or cheat sheets. Don't try and cheat the exam. I know I'm just repeating myself, but my advice when anyone says, how do I learn this? What's a good way? Learn it. Understand what it's doing. And what I mean by that is, if you said to me, okay, give me a quick way of learning what's going on with extended DuPont. Well, just think about what you're doing. So I'll just sketch up the bottom half of a mythical, made-up income statement. So we've got EBIT. I'm just going to make up some numbers because they look better than X's. Earnings before interest and tax. You then charge interest. Let's say that's 200. That's 800. So this is now earnings before tax. You then get taxed. Let's say that's 200, whatever. That gets you 600, which is net income. Now, net margin we know is net income divided by revenue. We're going to break that down, as I say, into three. Start with net income because that has to be there in the numerator. And then just look at the income statement and say, look, what I'm trying to do is analyze this, work out how much of that change in the net margin was due to changes in my core profit, my EBIT, how much was due to interest, and how much was due to tax. So start at the bottom of the income statement with net income and simply start moving up. Everybody knows if you're at the bottom of the income statement, you've got net income. First expense you'll come across is tax. Just jump over that and you'll get yourself up to EBT. So do that, EBT. Multiplied by, well, we're looking to get to net income over revenue. EBT doesn't feature, so you need that here to cancel out in the numerator. Divided by, or just keep going. We're at EBT. Let's go again. Everyone knows the next expense caption you see is interest. Jump up above that and you get to EBIT. We know EBIT's not in the ratio we're looking for, so it needs to go up here to cancel out. And we have our three ratios. We need revenue in the denominator, so that's got to be revenue. That's it. You don't need a cheat sheet. You don't need an acronym, a mnemonic. You just need to understand what you're trying to do. Try and work out, given a movement rather in net margin, where did it come from? Just break it down into these three elements. And once you see that, you think, oh yeah, I can see what we're doing. You can't help but remember it. Anyway, rant about cheat sheets over. What does it look like now? Well, net income over EBT. What's the difference between these two? Just the tax. This is the tax burden. EBT to EBIT, what's the difference? Interest. This is your interest burden. EBIT over revenue, something divided by revenue, we know is a margin. It's not net margin, it's EBIT margin. And as I say, you can't fail to understand now what we're doing. EBIT margin. It's your core business. We've separated out movements in your core business from changes in your interest makeup and changes in your tax rate. So let's do it for Walmart. What figures do we need? We need net income. That's fine. There it is. We have net income. I said I wanted to start with EBIT. Well, I don't have it. What I have here is operating income, not EBIT. Between operating income and net income, what do we have? We have some interest in here, which includes interest on debt, interest on finance leases, and some interest income to give a net figure. Then there would be a loss on extinguishment of debt if this were 2022, but nothing for us. Then we have other gains and losses, which is suitably vague, before we get to our income, our profit before tax, and our taxes. So this stuff is fine. But this is a bit of a mess. I want to define what EBIT is. All they've given me is operating income. Are they allowed to do that? Well, yes. Because at the moment, none of these none of these subtotals are defined by accounting standards. You don't need to put EBIT in. You don't need to put operating income in. IFRS is going to change that. Now, this is a bit of a stark looking slide because we're not doing a 3-hour deep dive into IFRS 18, but I think it's worth pointing out how exciting it's going to be. What IFRS 18 specifically does is define these two things: operating profit and profit before financing and income taxes, which is what I'm saying I kind of need at the minute because I want EBIT. It's not calling it EBIT though, it's calling it profit before financing and income taxes. But it defines exactly what should be deducted in getting to those subtotals: operating profit and profit before financing and income taxes, which any company reporting under IFRS is going to have to disclose, with exceptions. If you are a finance company, then this obviously doesn't make too much sense. But if you're not, if you don't make your money from generating interest, then you have to disclose these two subtotals. What gets deducted in getting down to them? Well, it should be operating income and expenses to get to operating profit, then investing income and expenses to get to profit before financing and income taxes, and then finally financing income and expenses to get down to what'll be profit before tax. Then obviously you charge tax to net income. As I say, this stuff's all pretty straightforward anyway. But that's the beauty of IFRS 18. It's really going to help, or it's intended to help, comparability. So let's try and apply that to the income statement we've just seen. So here it is again. Let's see if we can IFRS 18 it. We have operating income. It is 27012 for 2024. 27012. I'm going to trust that all of this represents operating income and expenses. Then I'm going to see what happens after that. Remember, IFRS 18 says to get from operating income to profit before financing and income taxes, which I'm just going to call EBIT here because we're doing a bit of DuPont, we need to deduct investing income and expenses. So let's see what we've got. We have, after the 27012, we have debt interest. Well, that is a finance cost. That's not investing. That's finance. We have interest on a finance lease. Again, that is going to be a finance cost. Then we have 546 of interest income. That is income from investing, income on debt. So I'm going to put that here, interest income. It's income of 546, so it's going to add to operating income. Not bothered about the 2137, that's just a subtotal. Don't have any loss on extinguishment of debt. If I did, that would be a cost resulting from financing. It would be a finance cost. Other gains and losses, I said, was suitably vague. Well, we do have detail on that in some of the notes. This final paragraph here, a couple of pages just before the income statement, tells us other gains and losses consist of certain non-operating items, which is why it's after operating profit, makes sense, such as the change in the fair value of our investments and gains or losses on business dispositions. The very definition of investing income or expenses. So these other gains and losses, 3027, I'll just call here other, it's really changes in the fair value of investments, 3027. That is an expense. And that gets me to income before income taxes. So I think that's all of my investing income and investing expenses. If we subtotal that, I get to 24,531. That's what I'm calling EBIT here, just so it ties into what you've got in the curriculum for DuPont, because that's the illustration we're using. But remember, under IFRS 18, that is going to be a requirement, but it will not be called EBIT. It will be called profit before financing and income taxes. Then we need to put in finance costs. Here they are, 2259 and 424. I'm just going to add those two together. That's interest expense of 2683. That would give me earnings before tax. And we're out of the IFRS 18 world now. The IFRS 18 is all about operating income and profit before financing and income taxes. But we need EBT just to get our little DuPont example going. So EBT, 24 less 2683, 21,848. Let's just check. 21,848. So we do have all of these expenses and all the income in correctly. Then we had our taxes, which I've just drawn over, but it does say 5578 to get to net income of 16,270. And obviously we could go on and do the same for 2023 for comparison purposes. And that's exactly what I've done here for 24 and 23. We had our revenue figures we just worked out for 24, EBIT, earnings before tax and net income. You can do the same for 2023. Then we can break down this surprising movement in net margin and try and explain it. And here it is. We said if you took the tax burden, the interest burden, and the EBIT margin and multiply them together, you get back to the net margin. That's the movement we're looking for. And if you do that, remember tax burden, you're starting at the bottom of the income statement. Just one more time, hopefully to prove a point here that, yeah, I understand what I'm doing. It's easy to remember. We're trying to break down net income over revenue. That's our net margin. We said we start at the bottom of the income statement. You move upwards. What's the first caption you jump over? Tax. You get to earnings before tax. That's your tax burden. EBT has to cancel out. What's the next caption you come to? Interest. So you jump up to EBIT. It's your interest burden. EBIT has to cancel out. We need revenue. There's your EBIT margin. So what do we get? 2.51 for 2024, 1.86 for 2023. So what's responsible? EBIT margin. There is actually an increase in EBIT margin from 3.16 up to 3.78. So some of this movement in our net margin has come from the core business. So that's certainly something we want to look at. Have they managed to control operating expenses a little bit better maybe? Interest burden. Not much of a movement there, so it's not that exciting. But finally, we get to the tax burden. And when you look at the tax burden, there is a large movement from 66 to 74%. What does this ratio tell you? Back in 2023, net income was 66.36% of your earnings before tax. In other words, your effective tax rate is 1 minus 0.66. Your effective tax rate was about 34%. Look at 2024. Now that's moved to 74.47%. That means your effective tax rate, 1 minus 0.74, this year is only around 26%. That's the change, and that's what you need to explain, because that is a big jump. Now, as it happens, it's not that exciting. Back to the notes again, and it is perfectly explained. Look at this first paragraph. Our effective income tax rate was 25.5, 33.6, as we've seen, and 25.4 for 24, 3, and 2. The higher effective rate in 23 is primarily due to the tax impact of a business reorganization. So it was actually last year that was the anomaly. This leap actually isn't that exciting. But nonetheless, I think it's a nice little example to demonstrate a couple of things. First of all, how just understanding what a formula is doing and understanding the analysis you're being asked to do makes it easy to remember a formula rather than looking at a cheat sheet. And secondly, just for those of you who are generally interested, go and check out IFRS 18. Its aim, 2027, as I say before, it's mandatory, but its aim is to help comparability. You're going to get operating profit and profit before financing and income taxes as subtotals on everybody's accounts. So look forward to that.